Hello everyone, welcome to the 178th episode of me learning how to trade in Forex. So in the last episode we finished off the using stops and limits to manage risk course with using limits lesson. So limits are useful for controlling how much you pay or make on a trade. When used properly, often in combination with stops to enforce particular risk to reward ratio, they're a very useful tool for your trading. So I went through different types of limits. So we've got limit close. A limit close order, also known as a take profit order, lets you decide ahead of time where you want to lock in the profits. So if you think your market price is going to go up, your limit order will be above the price you pay to enter the trade. If you think you'll go down, you place the limit order lower than the entry price. And it shows you how to set a limit order thing on the IG.com. So setting a limit close order gives you greater control over the profit you want to take from any trade. You can use them to manage the reward part of your desired risk to reward ratio. Many traders get excited when a trade goes in their favor that they exit position too early, so deciding where you want to take a profit before you open position helps counteract that instinct. So using a limit entry lets you enter a trade automatically at a better price. So use this if you are bullish on the market but thought it was currently overpriced, or if you're bearish but thought the market was underpriced. So if you're going long, you place your limit entry lower than the current market price, and if you're selling going short, it would be above. So you can place limit entry orders in the order. Alright, that tells you how to do it basically. So you might use a limit order to open if your analysis indicates that a market will drop before rebounding if you're going long, or rise before dropping if you're going short. So essentially you want to open the trade at that sweet spot of support or resistance before the change in direction. So some things to consider when using limits. Like stops, both limit entry and limit close orders are subject to slippage if market gaps through the order you've set. However, slippage isn't always negative. You can get positive slippage as well. So this happens where your limit is executed at even better price than you were expecting. It's also even a possibility that your order won't even be executed if the market never reaches your specified level, as it would never be triggered. So when you're using a limit open, you're currently placing a market order against the market trend, so which is a risk, because the market will likely move against you in a shorter term, so you might find that your order is triggered only for your position to immediately go into negatives. So remember to factor that in when you set up your trade to avoid exiting the market impulsively. So using limits with stops to enforce your risk to reward ratio. Using limits and stops together can give you a balanced risk to reward ratio. If you want to trade with a 1 to 2 risk to reward ratio, you place your limit order twice as far away from the opening price as you place your stop order. So with a risk to reward ratio of 1 to 2, that means you only lose half of what you stand to gain. And it tells you how you can see your risk to reward ratio on the platform, trading platform. Yep. Did the question and then went through the lesson summary. So now we're in the final bit, which is the quiz to round this up. So if you want to place a stop loss order on a long position, where would you place a stop loss? Below the current market level. Because going long, you're hoping it to go up, and you want the stop loss to be below it in case the market price didn't go up but it dropped down instead. So put a stop loss there to cap your losses. Your analysis showed that if a rising market hits a certain level, it will continue to rise. If this happens, you want to open a long trade. Which type of order would you use to speculate on a market trend like this? A stop entry order, because limit entry order is if it's a better price. So if you're going long, then you place a limit entry order below the current market price. What's considered the ideal percentage of account capital that should be risked on a single trade? 1%. 5% is the maximum. What is slippage? When your order gets filled at worse price than you set, when you move your stop order after you set it, when your order gets filled at a different price to the one you set. Yep. What kind of stop can you use to lock in profit? Guarantee stop, normal stop, trailing stop, any of the above. Trailing stop, oh no, any of the above. Guarantee stop, no, it's trailing stop, isn't it? Because these two are for stop losses. Trailing stop lets you move it following the market price so you can lock in profit. Yeah. You open a trade and set a stop 50 points away from your entry level and a limit 200 points away. What risk to reward ratio are you using? So your risk is 50, your profit is 200. Simplify that down, that's 1 to 4, because 4 times 50 is 200. Which type of order would you use to take some control over the profit you make? Take some control over the profit you make. Stop close order. No, take profit limit. Limit closer order. If you want to trade with a risk to reward ratio of 1 to 2 and you set your stop 130 points away from your entry price, what would you set your limit? So your risk is 130, 130 times by 2, 260. When is the ideal time to set a stop and or a limit? When the market moves against you and you start to lose money, as soon as you open your position. Yep. Using stops and limits can help you remove what from your trading. Select all that apply. Mistakes doesn't help you remove mistakes. Losses, nope. Emotional decision making. The need to constantly monitor them. Emotional decision making. 80, oof. So a stop loss automatically closes the position if the market moves against you. So on a long position, it will need to be set below the current market level. You use a stop entry to open the trade at a higher price than the current market price, whereas a limit entry lets you open a trade at a lower price. So in this scenario, you're setting up a stop entry order. Bear in mind that spread betting and CFD trading are leveraged. Many professional traders make a rule of never risking more than 1% per trade. So slippage is when your order gets filled at a different price to the one you crested due to a volatile market. When your order is filled at a worse level, this is called negative slippage. You can protect against negative slippage with a guaranteed stop, which will incur a small premium if triggered. You can also receive positive slippage where your limit order is filled at a better price than you requested due to high volatility. Oh, so then you need the above. You can use any type of stop to lock in a profit. Trailing stops automatically adjust themselves as the market moves in your favor. You can also do this with a guarantee that normal stops are manually moving them as your trade becomes more and more profitable. So your limit is 4 times away from your entry level than your stop, giving a risk to reward ratio of 1 to 4. Oh, it's a stop entry order, right. Limit close orders lets you specify a level at which an open trade should be closed out. If you're long on the market, then this will be above the current market level. If you're short, below. Okay. To get a risk to reward ratio of 1 to 2, you need to set your limit order twice as far away from your entry level as you set your stop order. So the ideal time to plan your entry and exit levels is where you open a new trade. If you set your risk thresholds as soon as you open the trade, you're more likely to stick to it. So setting stops and limits on your trades means you don't have to make difficult decisions under pressure. Plus, once they're set, you have to keep an eye on the market as your orders will manage the trade for you. Okay, so that's that done. I think that was using stops to manage risk, wasn't it? So yep, that's that one. So now we're on to trading options with CFDs. Trading options with CFDs. Looking for new strategies that can give you the edge in varied market conditions. Find opportunities in bullish, bearish, or even static markets with options CFDs. Whether volatility is high or low, these leverage products can help you to profit from it, even if you're not sure which way the prices are heading. In this course, you'll get a thorough introduction to options, how they work, the benefits they offer, and the risks you need to understand. Plus, you'll learn some popular options trading strategies that can unlock exciting potential in the markets. So let's go then. What are options? What are options? What are options indeed? What are options? So 26, 06, 2024. So what are options? When you trade in the traditional way, you simply buy an asset if you think it will rise, or sell it short if you think it will fall. Trading options opens up some other possibilities. There are several types of options. Understanding how they work is vital. In this course, we'll focus on vanilla options, a popular choice for traders who want to start expanding their strategy. An option is a contract that lets you trade on the future value of a particular financial asset. So an option is a contract that lets you trade on a future value of a particular financial asset. When you buy an option, you're paying a premium for the right to buy or sell the assets at a set price on or before a set date when the option expires. When you buy an option, you're paying a premium for the right to buy or sell the asset before at a set price on or before the option of a set date, before a set date when the option expires. Options are similar to futures in that if they let you speculate on future price, but unlike futures, there's no obligation to trade if you don't want to. For example, say you have an option contract that allows you to buy gold at 1,300 for next week. If gold hits 1,325 for example, you could exercise your option to buy it for 1,300, which is $25 less than the current market price. If gold stays below your option price, falling to say 1,275, then there's no obligation to buy it for 1,300. By choosing not to trade, you'd avoid paying above the market price, although you'd lose a premium you paid for the option. So how options work? There are two types of options, calls and puts. So two types of options, calls and puts. Call gives you a right but no obligation to buy an asset at a set price on or before a set date. Put gives you the right but no obligation to sell an asset at a set price on or before a set date. So call gives you the right but no obligation to buy an asset at a set price on or before a set date. A put gives you the right but no obligation to sell an asset at a set price on or before a set date. Buy a call option and you take a long position on its underlying assets. The more the price rises, the more profit you can make. Buy a put option and you have a short position. The further the market drops, the more profit you can make. So take a long position when buying a call option. The more the price rises, the more profit you can make. So the other one is take a short position when buying a put option. The more the... why is that not in caps? The more the price drops, the more profit you can make. You can also sell an option, but that's a little more complicated and we'll look at it later in the course. Calls and puts both have an expiry date. You don't have to buy or sell if the market doesn't move the way expected. So calls and puts both have an expiry date. Whoa. You don't have to buy or sell if the market doesn't move the way expected. But once either option expires, it will become worthless. You lose a premium paid for it, but nothing more. Buy or sell the option. Buy or sell, the underlying asset if the market doesn't move the way you expect. It will become worthless. But once the option expires, it becomes worthless. You lose a premium paid for it, but nothing more. Once the option expires, it becomes worthless and you lose the premium you paid for it. But nothing more. So if our gold example, a call option should mean that you pay a lot less to open your position than if you bought gold itself. If the price of gold goes up, you can buy it at a bargain price and profit from reselling it. If you have a put option and the price falls, you can buy a lower price and profit by selling at the higher price agreed when you took out the option. Alternatively, you could sell your option itself without ever exercising it, known as closing out, profiting from the price movement without committing a great deal of capital. So you can sell your option without exercising it, known as closing out. Profiting from the price movement without committing a greater deal of capital. If the market doesn't move the way expected, you don't have to exercise your option, limiting your losses to what you paid for the option itself. Doesn't move the way you expected, you don't have to exercise your option, limiting your losses to what you paid for the option itself. And then we've got a little video here to watch. So
options, a hugely powerful trading tool with a wide variety of uses. But what exactly are options and how do they work? An option is a contract, just like a future or a CFD. It gives you the right, but not the obligation, to trade a financial market at a set price before a set date in the future. To get this right, you pay a premium. Say you think the FTSE 100 is going to rise in the next week. Instead of buying the FTSE now, you purchase an option to buy it within the next 7 days. This is known as a call option. It gives you the right to buy the index at a set price called the strike before the option expires. If the FTSE moves above the strike, you can exercise your option and buy for less than the current market price. If the FTSE drops instead, you can leave your option to expire, losing only your premium. But options aren't just used to buy a market. Put options give you the right to sell a market at the strike instead of buying. This can make them a great tool for hedging. Say you own Apple stock and are worried that it's about to fall in price. Instead of selling your stock immediately, you purchase an option to sell it with a strike that's close to the current market price. If Apple stock drops, you can exercise your option to sell, preventing losses by selling above the current level of the market. If Apple stock rises, you can keep it in your portfolio, again only losing the premium. You can also use options to speculate on price movements without ever intending to buy or sell the underlying market. That's because an option's premium will change over time, depending on how likely it is the option will become profitable. So if you purchase an option with a low premium, you can sell it on if it becomes worth more as it nears expiry. With IG, you can trade an extensive range of call and put options on shares, indices, Forex and more. Open an account now to start trading options.
nice. So that's a very nice little summary of options. So if you expect the price of US light crude to fall and want to trade with an option, what should you do? Expect to fall, then you buy a put. If you think the market is going to fall, buy a put option, which gives you a short position. You have the right to sell at the price you set, which can be higher than the market. The further the market drops, the more profit you can make. So how options can generate a profit? When you buy an options contract, you aren't physically buying anything. No asset is actually transferred. When buying an options contract, no asset is physically transferred. When you decide to exercise an option on the grounds that doing so will earn you profit, it gives you the right to buy the underlying asset from an option seller. At IG, we'll settle this with a cash payment. When you decide to exercise option on the grounds that doing so will earn you profit, it gives you the right to buy the from an option seller. At IG, I'll settle this with a cash payment. Option seller. So what can you trade with options? Options are flexible and allow you to trade a huge number of assets. Like futures, options can be used to buy and sell assets that will cause logistical issues such as oil or gold. With IG options, for example, you can trade assets such as Forex, including major pairs like Euro USD, GBP USD, USD JPY and EUR GBP, shares including FTSE 100 stocks and a selection of leading US equities, stock indices including FTSE 100 and Wall Street, commodities including metals and energies, further equity options available via phone trading. When you trade options with us, you don't actually own the underlying option, you're simply speculating on its value using a CFD, so contract for difference. Understanding the terms. Options have some key terminology used by traders. Here are some expressions you may come across. So holders and writers. The buyer of the option is called a holder while the seller is the writer. So buyer of the option is called the holder. The seller of the option is called the writer. In a call, the holder has a right to buy the underlying asset from the writer. In a put, the holder has a right to sell the underlying asset to the writer. Yep. Premium, the fee paid by the holder to the writer for the option. The fee paid by the holder to the writer for the option. Strike price. The price at which the holder can buy, call or sell put the underlying asset. The price at which the holder can buy, so that's call or sell, that's put the underlying asset. Expiry, the date and time when the options contract terminates. The date and time when the option contracts expires or terminates. After expiry, the option is worthless. If the underlying market doesn't hit the strike price before expiry, the holder can't earn a profit. After expiry, the option is worthless. If the underlying market doesn't hit the strike price before expiry, so it doesn't hit the price at which the holder can buy, call or sell put the underlying asset, the holder can't earn a profit. If the underlying market doesn't hit the strike price before expiry, the holder can't earn a profit. In the money. When the underlying market's price is above the strike or call or below the strike for a put, meaning the holder can exercise the option and trade at a better price than the current market price. So when the underlying market's price is above the strike, so put for a call, never mind, for a call, or below the strike for a put, meaning the holder can exercise the option. So the holder can exercise the option to trade at a better price than the current market price. Out of the money. When the underlying market price is below the strike for a call or above the strike for a put, meaning that exercising the option will result in a loss. So when the underlying market's price is below the strike for a call or above the strike for a put, so the hold can't exercise the option as it will result in a loss. At the money. When the underlying market's price is equal or very close to the strike. When the underlying market's price is equal or very close to the strike price. So what does options trading cost? The cost of opening position with IG includes an option premium and the dealing spreads. The differences between the bid and ask spreads. The more likely it is that an option will move above with calls or below with puts the strike price, the higher its premium will tend to be. The more likely it is that an option will move above with calls or below with puts the strike price, the higher its premium will be. But how do you know whether it's more likely or less likely though? There will be no commissions for CFD options. Only only charges the spread. But how do they work out its likelihood though? I'm assuming that if it's like, could it be like really close to the market price, so then there's a higher chance of hitting it. And if it's like really far away from the market price, then it's less likely to hit it because it's really far away. So maybe is that how they're gonna do that? Okay. So how do option prices work? Options pricing is complicated and doesn't always move one for one with the underlying asset. So options pricing is complicated, doesn't always move one for one for the underlying assets. At IG options, prices are set by our dealing desk based on three key factors. The time to expiry. The longer an option has before it expires, the more time the underlying asset has hit the strike price, so the premium will be higher. Options pricing can be based on three factors. The time to expiry. The longer an option has before it expires, the longer the underlying asset has to hit the strike price. The higher the premium. The current level of the underlying market. The closer the underlying asset is to the strike price, the more likely it is to hit and pass the strike price. So an option 50 points away from the current level of market will be less likely to become profitable than the one with a strike price 15 points away, meaning it should have a lower premium. the closer the underlying asset is to the strike price, the more likely it is to hit and pass the strike price. So an option 50 points away from the current level of the market will be less likely to become profitable than the one with strike price 15 points away, meaning it should have a lower premium. The higher the premium, the volatility of the market. So the more volatile the asset, the more likely it is that the option will hit its strike price. So options in a volatile market will see higher premiums. The more volatile the asset is, the more likely it is that the option will hit its strike price. The higher the premium. The premium you pay to open an option can be your maximum risk if you're buying. This is not the case if you're selling. We'll explain more about it later in the course. The premium you pay to open an option when can be your maximum risk when buying. However, it's not the case for selling. This is not the case for selling. We'll explain more about that later in the course. So let's do a summary. An option is a contract giving the owner the right but not the obligation to buy or sell an asset before a set expiry point. Buying or call allows you to go long, while buying put enables you to go short. Options are flexible and allow you to trade a huge number of assets, including Forex, shares, and stock indices and commodities. The more likely an option will move above with calls or below with puts the strike price, the higher the premium will be. For bought options, the premium you pay to open is your maximum risk. Cool. So what are the benefits of trading options then? So what the benefits of trading options? Options trading is not without risk, as we'll explain in lesson 4. However, it can be very attractive for retail traders, as it gives you the opportunity to gain a very large exposure of only a small capital outlay, smaller than the capital required when trading the underlying instrument. Leverage. Options also allow you to profit within short or medium time frames, rather than having to wait months or even years for an asset to move and generate a profit. Options allow you to profit within short or medium time frames, but the benefits don't stop there. Options trading provides some important advantages over other approaches to the market. First, it can allow you to make money no matter what the market is doing. It doesn't matter whether the market is bullish, bearish, or even static, there can be opportunities to profit with options trading. If the market is rising, you can make money by buying an asset below market with a call option. Alternatively, if the market is falling, a put option lets you sell the asset at a set price above the market. Of course, you can short the market by selling the underlying assets if you know how, but options allow you to put a lot less capital at risk. If the market goes flat, with any forms of trading, there's not a lot you can do except hold on and hope things improve. But with the right strategy, as you learn in this course, you can use options to make money from an asset that's going nowhere. You don't need to be familiar with the entire market. If you focus on a few favorite currency pairs, for example, and become familiar with their movements and patterns, you can plan an option strategy designed to earn money from those patterns. Don't need to be familiar with the entire market for options. focus on a few and become familiar with their patterns and movements. So harnessing leverage. Options enable you to trade using leverage. Of course. Options enable you to trade using leverage. Meaning that the amount you pay to open is only a fraction of your trade's potential full value. This enables you to command a large position in the market with a relatively smaller payment. As a result, your potential profits are magnified, although the same goes for any losses you make. So how are options used? There are three main reasons for trading options. For trading options. To speculate on the price movements of various markets. To speculate on the price movements of various markets. To limit your risk by hedging. To limit your risk by hedging. To trade on volatility or the lack of it. To trade on volatility or the lack of it. Let's look at these in turn. The flexibility of options has made them a popular tool for speculation. That's because the prices that options trade at will vary depending on a number of factors, including how much time you have left to exercise your right to trade and the value of the underlying asset. An option to buy gold for 1,300, for instance, will typically be traded at a higher price when gold is at 1,299 than when it's at 1,200, reflecting the probability that the strike price will be hit. Speculators might trade options with no intention of ever exercising them. Instead, they'll buy an option to then sell it on when its premium increases. The flexibility of options are popular with traders, as the prices that options trade at will vary depending on a number of factors, such as how much time you have left to exercise your right to trade and the value of the underlying asset. An option to buy gold for 1,300, for instance, will typically trade at a higher price when the gold is at 1,299 than when it's at 1,200, reflecting the probability that strike price will be hit. Speculators might trade an option with no intention of ever exercising them. Instead, they'll buy an option and sell it on when its premium increases. Okay, hedging. Options trading was first devised as a hedging tool. Say you own stock in a company, but were worried that its price might fall in the near future. You could buy an option to sell your stock at a price that's closer to its current level. Then if your stock price falls, you can exercise your option and limit your losses. If the stock's price increases, then you've only lost the cost of buying the options in the first place. It can be an important safety net if you're worried about profitability, about volatility. So buy option contracts in case you are worried about volatility. Yeah, that's all I can say, to be honest. Profiting from volatility. Volatility can be a source of profit too. With options, you can take positions that will let you profit from variability in the price of an asset, even when you believe that volatility will be low. Can take positions that will let you profit from variability in the price of an asset, even when you believe that volatility will be low. So maximizing power of leverage. With options, it's possible to pay a relatively small premium for market exposure compared to other leveraged trading products like futures. As a result, options can potentially give large percentage returns gains from a relatively small initial outlay. So for example, suppose you trade FTSE futures, buying one contract worth £10 per point at 6,000. Your deposit's 300. If the FTSE then sees a 10% increase, climbing 600 points to 6600, you make a profit of 600 times by £10, which is £6,000. But what if instead you buy a call option on the FTSE? Say the strike price is 6250, and you buy 30 contracts. One contract is £10 lot size, at a price of 10. Your outlay is again 300. In the same scenario as above, a 10% FTSE rally means your option will expire in the money by 350 points, and now your profit is 350 minus 10 times 30, which is 10,200. So there's potential for a much larger profit of option compared to trading futures, but keep in mind that the risk of rapid loss also increases whenever you use leverage. So trading options with CFDs. One way to trade options with CFDs, in this case, instead of getting the right to buy or sell the underlying asset, you're trading on the actual value of the option. Trading CFDs or contract for differences allows you to speculate on whether the asset's price will move up or down without having to own the assets. One way to trade options is with CFDs, which allows you to speculate on whether an asset's price will move up or down without ever owning the asset. We offer CFD options at IG. Okay. So question 1. If the market is rising, you can make money by buying asset below the market by buying a call option, buying asset below the market by buying a put option. If the market is rising, buying asset below the market you can make money buying asset below the market. It's a call. When buying a call option, you acquire an asset for less than its market value and profit from the difference. If you answered B, make sure you're clear on the difference between calls and puts. So when the market's falling, you can make money by selling the asset at a set price above the market by buying a put option. When buying a put option, you can sell an asset for more than its market value and profit from the difference. If the market is rising, you can profit by buying an asset below the market by buying a put option. A call option, sorry, not put. If the market is falling, you can profit by selling an asset by buying a put option. This is the put option. By buying a put option. So options trading provides the opportunity to trade a very large exposure of only a small capital outlay when buying options. Options can allow you to make money no matter what the market is doing. Doesn't matter whether the market is bullish, bearish, or even static. Options trading can be used to speculate on market movements. Options may be used for hedging, limiting losses from a portfolio. Because options are leveraged, the profits can be higher than buying an asset directly, although the risk of loss increases too. You can trade options with CFDs. So, yep. I'm going to leave this episode here then. So, thank you all for watching, and I shall see you guys in the next video. Laters, alligator.